back to the Gold Standard. I'm Marcus.
And I'm Sasha. Marcus, gold just had one of its biggest days in months.
Kitco called it the metal's largest single-day advance in 5 months. We'll dig into what pushed it there.
Silver has been busy too. It cleared a technical level everyone's had circled on their charts.
And the positioning data shows speculators leaning into that trade harder than they have in 2 years, which raises the question, are the big players still comfortable or getting nervous?
We'll get into that. Now, related to that, Wheaton Precious Metals just dropped numbers that turned heads.
Record quarter, bigger dividend.
Right.
For folks holding mining names, that's worth a look.
And to close things out, we're watching central banks quietly rebuilding gold reserves. Korea, China, moves that don't get enough attention.
Which feeds right into the big price target everyone keeps asking about.
We'll weigh that. Sasha, where do you want to start?
Right where the money's already moving, gold's 7-week peak.
Let's follow the gold.
$4.2% in 1 day. Gold hasn't moved like that in 5 months.
Okay, real talk. That's not a normal Tuesday. What actually happened?
Wednesday, actually. Gary Swagner's Kitco column laid it out. Gold cleared resistance at 4,200, blew through the 50-day moving average, and touched an intraday high above $4,328.
And it held?
It held. Settled around 43.08, a gain of nearly $174 on the day. And the trigger, according to that same piece, was President Trump saying Iran's in active talks about reopening the Strait of Hormuz.
Okay, but walk me through that. A shipping lane in the Middle East, why does that move the price of gold in New York?
Think about what the strait actually is. Roughly a fifth of the world's oil moves through there. Close it, or even threaten to do so, and you're pricing in an oil shock. Reuters tied gold's move directly to that. They had it touching a 7-week peak on reopening hopes.
So less oil fear means less inflation fear, which means the Fed doesn't have to hike as hard to fight it.
Exactly. And that's the mechanism. Lower rate expectations make a non-yielding asset like gold more attractive, not less.
Wait, so good geopolitical news is bullish for gold? That feels backwards.
It is a little. Normally gold rallies on fear. Here it rallied on the fear easing, because the fear had been suppressing the Fed's room to cut. Bloomberg's coverage this week called it exactly that, gold holding its gain as Hormuz progress lowered rate hike odds.
And then jobs data piled on.
Right on cue. CNBC reported gold hit its highest level since June after a weak payrolls print, spot gold spiking as high as $4,295 before settling near $4,268, with futures around $4,329.
Weak jobs, soft economy, that's usually scary, but for gold, it just means the Fed is less likely to hike.
That's the read. Same logic as Hormuz, different headline.
Okay, so where's the money actually flowing? Because I keep seeing GLD mentioned everywhere.
Benzinga flagged that this week. ETF inflows into GLD picking up ahead of the U.S. inflation print, with the metal eyeing resistance near $4,500.
For the folks at home, that's not investors buying coins and bars. That's funds buying shares that track the metal.
Correct. And it's a fast way to see institutional appetite. When those inflows accelerate before a data print, it tells you positioning's leaning one direction.
Bullish.
Bullish. Now, here's the historical piece I keep coming back to. We saw this pattern in the early 90s Gulf crisis. Oil-driven fear premium built into gold, then unwound fast once the threat to shipping eased. The shape of that trade rhymes with what we're seeing now.
So the premium's real, but it's fragile.
That's the tension. A Hormuz deal that actually holds could deflate part of this move overnight.
Which is exactly why I want to know, if that premium comes out, does gold just give back the $174?
That's the open question. Depends whether the inflation print backs up the rate cut case on its own, deal or no deal.
Okay, so gold jumps 4% on a shipping lane and a jobs mess. Same week, same job number. What did it do to the noisier metal in the room?
Let's find out, because silver didn't just follow gold's lead this time. Speaking of that jobs shock rippling through metals, silver felt it even harder than gold.
Way harder. FX leaders had it trading around $64, up more than 11% over 7 days.
And USA Today logged the same day move at 2.92%, settling near 61.18 once the dust cleared.
So it spiked, then cooled a touch. Still, that's not a move you see in silver often.
FX Empire flagged the technical piece too. The rally cleared the 50-day moving average as rate hike odds fell.
Break that down for me. What does clearing a moving average actually tell a trader?
Think of the 50-day line as the average price over the last 10 weeks. When price pushes above it on real volume, the recent buyers have taken control, and that's a shift worth watching.
So that's a shift in the trend, plain and simple.
Exactly. And with rate hike odds falling, cheaper money, a weaker dollar, buyers get a tailwind instead of a headwind.
Okay, but here I get skeptical. FX Street's positioning data shows large speculators just hit a 2-year bullish extreme, and commercials are moving right alongside them.
Walk me through what that pairing actually means.
The COT report splits traders into 2 camps. Speculators are the fast money betting on direction. Commercials are the producers and dealers hedging real physical exposure.
Right. So commercials selling into a rally is normal. They're locking in prices on metal they're going to deliver anyway.
But when speculators are this crowded at a 2-year high, who's left to buy?
So we saw a setup like this in 2011, right before silver's spike unwound hard. That doesn't mean this one will rhyme the same way.
So which way does this one go?
Crowded long positioning has preceded sharp pullbacks before. It's also shown up early in genuine multi-month runs. The commercials matter more than the speculators here.
Why commercials specifically?
Because they're hedging actual metal they have to deliver. If they keep adding shorts at this pace, that's a sign of a stretched market. If they start pulling shorts back, that's them betting on higher prices too.
So FX Street isn't handing us a verdict.
It's a flag, not a forecast.
I'll take crowded but confirmed over crowded and nervous any day.
And that tension between positioning on paper and cash flow in the real world matters for what comes next.
Because somebody's cashing checks off these prices.
Which brings us to Wheaton Precious Metals. Record numbers this quarter, and a dividend hike that tells you exactly where management thinks this is headed. Speaking of prices actually landing somewhere concrete, Wheaton Precious Metals just posted the numbers. Wheaton Precious Metals Corp. reported record year-to-date production, sales volumes, revenue, and earnings for the first half of 2026.
Wait, record on every line? That's not just a good quarter, that's a clean sweep.
And cash flow. All 4 categories, record. President and CEO Hytham Hodali, as MarketBeat reported from the earnings call, said the first half reflected higher commodity prices, more sales volumes, and contributions from newer streams ramping up.
So here's what I want to know. What does a record quarter actually buy shareholders?
An 18% dividend increase. Yahoo Finance Singapore tied that directly to management's confidence in future cash generation.
18% is a big jump off one quarter's confidence. That signals management conviction about the cash generation pipeline.
It is, but Wheaton isn't a miner in the traditional sense. They don't dig. They fund mines up front, then buy the gold and silver output at a locked-in price for years, sometimes decades.
So, while a mining company is fighting rising diesel and labor costs to squeeze out margin, Wheaton already locked its cost. Every dollar gold or silver adds on top just runs straight to their bottom line.
Yahoo Finance's earnings preview flagged that exactly going in. Higher gold and silver prices were expected to drive sharp sales and earnings growth for Wheaton specifically because of how the streaming contracts are structured.
And they proved it. Investing.com had the record framing across the board.
Reinvestment is minimal here too. Wheaton isn't sinking capital into new shafts or equipment. That's the mine operator's job. So more of that cash flows to owners rather than back into the ground.
Which is a pretty different structural bet than what we're about to look at.
Exactly. Wheaton's converting record prices into cash and handing it back to shareholders. Some of the biggest buyers in this market are doing the opposite.
Converting cash into bullion instead.
And central banks have been doing that quietly for months. Shifting to the official sector, Bank of Korea just filed plans for its first physical gold purchase since 2013. That's over a decade on the sidelines.
Wait, 13 years? What changed?
A report translated by UPI frames it as reserve diversification against geopolitical risk, done gradually and on purpose.
So Seoul sat out the whole 2020 gold run, the pandemic, all of it, and picks now?
Domestically produced gold, too, according to that report. Small, deliberate, and quiet.
Meanwhile, China's not being subtle about any of this.
Not at all. Kiko News reported the PBC bought 20 tons in July. That's its largest monthly purchase since October 2023. That's 21 straight months of buying.
Wow. 21 months. That's basically 2 years of we're not done yet.
And Reuters separately confirmed China's gold reserves rose by the most since that same October 2023 stretch, with the buying pace clearly quickening.
What does quickening actually mean?
They're adding faster than 6 months ago. And Bloomberg reported the PBC is now adding gold specifically in Hong Kong, building out that city as a trading hub.
So it's stockpiling and building infrastructure around the metal at the same time.
That's the read.
So for anyone holding gold right now, does central bank buying even move the needle for me?
It adds a floor of demand that isn't chasing charts the way retail money sometimes does. A central bank doesn't sell because the RSI looks stretched.
Right, they're not day trading it.
Correct. And that's part of why Reuters reported UBS now sees gold reaching $5,000 in the first half of 2027.
5,000? That's a real move from here.
UBS's case leans partly on exactly this, sustained official demand stacked on top of investment flows.
Is that call really about central banks, or is it writing the same jobs data story we started the show with?
Probably both. The buying gives the floor, but UBS's timeline still depends on where the Fed lands.
So what should we watch this week?
The U.S. inflation print everyone's circling, whether Korea's plan turns into an actual filed purchase, and any fresh reserve data out of Beijing.
3 things to track for anyone holding metal.
That's what the smart money is watching closely right now. So gold's Hormuz-driven surge was the week's biggest move, and it's a reminder how fast a geopolitical premium can build.
And unwind. Silver actually outran gold, which tells you speculative money is chasing this rally hard.
Wheaton's 18% dividend raise showed how that streaming model turns higher prices straight into cash for shareholders.
Which brings us to central banks. Seoul and Beijing both stepping back into the gold market quietly.
That's the real story here. Official demand quietly outpacing trader flows.
Quiet is right. If that keeps up, UBS's 5,000 call starts looking less like a stretch.
If this episode helped you make sense of the moves, subscribe and leave us a review.
And send your questions to goldstandard@heymotto.com. We read every one.
Thanks for spending this hour with us.
We'll be back next week, watching the gold. See you then.